So we'll start with a review on current issues in financial markets. Now, this is the part of the FRM Part 2 exam that gets updated most frequently. So it normally changes every year, and the most recent issues in financial management and in risk management are what are highlighted here. So this time the institute has decided to focus a lot on high-speed trading to educate us what it is and what are the risks associated and how are people going about managing those risks. So let's first understand what high frequency trading or algorithmic trading means. So the topic is titled Controlling Risk in a Lightning Speed Trading Environment. So algorithmic trading and high frequency trading generally mean the same thing. So what is this trading vis-a-vis the traditional trading, also called low frequency trading or LFT? So what is HFT versus low frequency trading? So low frequency trading is the trading that the traders or the human beings normally do. So they will buy stocks that they think are undervalued. They will place an order of buying, let's say 100,000 shares, and slowly that order will get executed. So if you're a buyer, you will need to find a seller, so you will give the order will get matched over an exchange and get executed. Similarly, if you want to sell a stock, you will give a sell order, and then when a buyer is there, or it'll be matched against buy orders on the exchange, and the order will get executed. So that's what low frequency trading is. That is the normal trading by institutions, by retail investors, by human beings that is done, that is orders are punched and then executed. Now, high frequency trading or algorithmic trading is what is incrementally constituting the bulk of the trading in the United States especially, and growing very fast all over the world. So this is essentially computer determined trading. That is, it is a computer program that will buy and sell with the smallest possible delay or with the smallest latency. So it is about speed as well as certain other features that we'll study. That's why high frequency. So what these traders do, or what these programs at times do, is use super high speed computers to trade. These computers will generally look for predictable patterns from which they can profit. So if they'll see that some investor is continuously buying, or some low frequency trader, that is a human being or a retail investor or institutional investor, is buying, they would try to profit from that opportunity, because the buying will cause the stock price to go up. So the high frequency algorithm or the high frequency trader will come and buy that stock before the investor's buying is complete, so that he can profit from that buying pattern and sell when that buying is over, as predicted by the algorithm. Similarly, if he sees a lot of selling in a stock, it will try to profit from that selling, because it knows that selling is going to drive the price down. And how will it be able to guess if there is buying or institutional buying or selling in a particular stock? It's because we see that human beings generally put their orders in fives, tens, hundreds, thousands, that is in round numbers. So computers will realize that this is probably some human being or some low frequency trader that is trying to input the orders. So a computer can observe such things, such as buying in round lots, etc., and then attempt to profit from that action, because if it predicts that this buying is going to continue for some time, that means the stock price is likely going to go up. So the computer will also try to buy in and sell at the end of that trade, so as to profit from these little opportunities. So this kind of trading often reduces spreads, because it engages in intermarket arbitrage. So if it sees some mispricing, it will try to correct that mispricing or profit from that mispricing. So it will often buy in one market, sell in another, so liquidity improves, spreads increase, or rather spreads decrease, and in general the liquidity in the market becomes better. So a high frequency trading algorithm or a trading program will move liquidity from where it is abundant normally to where it is required more. So what are the benefits of high frequency trading? As we understood, it will reduce spread, increase liquidity. For these programs, even short spans of time, milliseconds are very important. So a lot of times firms will co-locate their servers nearer to the matching engines of the exchanges so that trades can be executed faster, orders can reach the exchange faster. So these programs try to predict the relationship between the securities and calculate the variances and covariances between the securities. For instance, when one stock goes up, the computer calculates the probability that a related stock, so if one steel stock, for instance Tata Steel or Chorus, goes up, then generally that is because of some steel price action or cost action. So it generally should impact all stocks in the sector. So the computer will calculate the probability that other stocks should also increase, and if they haven't yet increased, that means it's an arbitrage opportunity. So it will trade the stocks that are expected to increase in split seconds. So that's the kind of algorithms and the kind of trading that can be done using these computer programs and that fall under the gamut of high frequency trading. So high frequency trading is not necessarily predatory as some people think. So uh, it it doesn't necessarily try to confuse market participants, or it doesn't try to cause the stock price to go excessively high or cause the stock price to go excessively low, or it's not necessarily a predatory phenomena as some people think, and as we'll discuss in the coming slides. So humans think not only in round numbers, as we discussed, that they will place their orders in tens, fives, hundreds, thousands, but also in terms of time. So if a human places an order, generally he will place small quantities of the order throughout the day. So let's say a trader wants to sell 100 shares. So what he'll do is, in order not to impact the price, he will not sell the entire quantity in one go. Rather, he'll start selling 10 shares every half an hour or every 1 hour. So humans tend to think in terms of time, that is, they will try to split the order throughout the day. However, the computer does not necessarily think like a clock. He thinks in terms of the amount of volume or the liquidity to execute a trade. So it takes longer, for example, to trade several 100,000 futures in the middle of the night when the volume is low than in the middle of the day when the volumes are higher, people are awake and trading. So the computer will normally increase the trading volume at times of good liquidity or times when volume is high. So the computer will not necessarily place an order like this. The computer will place a higher volume of the order to be executed during times of the day where liquidity is more, and lesser when the liquidity is less. So it thinks like a volume clock rather than a human being who will normally just try to get the average liquidity or spread the order throughout the day. So that's also an advantage, you can say, or that's also one way of trading that a high frequency algorithm will do. The bad aspect of HFT is that it can sometimes be predatory. So algorithmic trading sometimes has a predatory nature. That is, the high frequency traders will engage in sequential games to take advantage of low frequency traders, or the human beings, or the real investors. So algorithms can produce a foreseeable outcome which the computer can then exploit. So if the computer predicts that there's going to be incremental buying because a low frequency trader is putting in orders in lots of 100 or lots of 1,000, then it can go and further buy this stock and drive the price even higher because it wants to exploit the outcome. So some examples of predatory algorithms is a quote stuffer. So the quote stuffer tries to slow down competing algorithms. So it will flood the exchange with random messages. So messages of orders, order cancellation, order confirmation, etc. So another algorithm may think that there is a lot of trading happening in the stock. So the other algorithms also start placing a lot of orders on this stock. Similarly, they can be code danglers. So the idea of this algorithm is to confuse the other algorithms or to muddy the quote process. So orders are entered and instantly cancelled thousands of times, and the computer actually never trades. So the aim again is to convince another computer to raise its bid on apparent but not real volume. So if the computer takes the bait and raises the bid, the code dangler will then sell or buy at a profit. So this kind of an algorithm tries to predict how other algorithms are programmed and then take advantage of that fact. So if this algorithm knows that the other algorithm has been trained to work in a particular way, that is, it wants to trade when liquidity is high. So that means it will try to execute the trade if liquidity is high. That means if he wants to buy, he'll start bidding higher. If he wants to sell, he'll start offering at a lower price. So it'll try to confuse that other algorithm and take advantage of that trading by manipulating the other algorithm. So this is one of the problems of HFT, that the algorithms can be predatory. Another predatory algorithm is a pack hunter. So in this case, the pack hunter, the algorithm becomes aware of each other's independent actions. So if it sees that one algorithm is selling, then it will join forces to maximize the chance of causing an instrument's price to fall. So if one algorithm is selling, it will also start selling. So the price will move down in this case until it identifies the stop loss price or the stop hunting price. And then once there is a stop loss, that is, the institutions and the other low frequency traders start selling because they are in a loss. So let's say the stock price was $100. Now everything was fine. A lot of institutional investors were holding the stock, a lot of hedge funds were owning it, a lot of retail investors were owning it, and all of them have in general a 5% or 10% stop loss limit. That is, if the stock price goes down by more than 5% or more than 10%, for instance, then these retail investors, hedge funds, or we can say low frequency traders will do a stop loss. So what the pack hunters will do is they will come and all of them together they'll start selling the stocks such that the price goes down by more than 10%, goes down to 89, such that these low frequency traders, even though fundamentally are positive on the stock, but they have to, for risk management or risk limits, whatever reason, because their stop loss is hit, they will need to now sell. So once the stop loss is hit, these low frequency guys will start selling this stock. Then these pack hunters will reverse their position. That is, now they'll start buying. So they'll sell at 100, they'll sell at a higher price and buy at a lower price, profiting from this stop loss or profiting from these low frequency traders. And the price will come back up. So basically the HFT or the pack hunters have gained because they shorted at a higher price and they bought back at a lower price, the price of the stop loss of these hedge funds or these low frequency traders. So what the low frequency traders, the retail investors, the institutions, etc. have to do is that they must be able to find liquidity without leaving a footprint. They must learn to trade periods when there is more volume and they are less detectable. They must also avoid telltale signs like trading or putting orders in round numbers or lots when they trade. So the low frequency traders, these hedge funds, human beings, must be invisible to these algorithms so that they don't get exploited by these algorithms. The phrases algorithmic trading and high frequency trading are often used synonymously. So what has led to the evolution of this high frequency trading? So first of all is the high computing power that is now available. So super high speed computers and electronic execution is making high frequency trading possible. Big data and analytics are now available. So some traders have a distinct advantage over others in terms of information. So HFTs look at level 3 quotes. That is the highest level of access afforded to market makers. HFTs use order book depth to figure out where their orders are going to be. They use their understanding of how the exchange matching engines work and estimate other market participants' liquidity needs. For instance, on April 2, 2015, a hacker published on the social media that president of the country is hurt in a major explosion at a public addressing or a public meeting. So this post was immediately translated into a sell signal and the market dropped more than 200 points in a matter of minutes. The story was false and the market recovered also instantly. So this is the extreme example of the effects of trading on big data. So these algorithms are so shrewd today, or rather they can be programmed so well that they can scan the available social media, Facebooks, Twitters, etc., and then put orders based on the news flow that they gather from these sources. They can try to follow the orders of institutions or traders that have more access to the market and try to follow their orders and see where the market is going to be headed and try to profit from that information. So the availability of good computing power, big data and analytics is making this trading through computers and algorithms possible, which can be much faster than humans, or which can trade much before humans will be able to detect and react to the same information. Similarly, natural language programming is another tool that is available. So the HFTs are able to read millions of web pages, allowing them to trade on new fundamental information. So they can digest the information from web pages, generate statistics that will give them buy or sell signals. Firms are developing sentiment indices using this information. So Watson, IBM supercomputer that played on Jeopardy, now works for hedge funds, deciding how to trade on information gleaned from reading millions of web pages. Ability to identify patterns, of course, so they can detect LFTs trading behaviors, as we discussed, using algorithms, using round lot tradings. So LFTs are also called graphical user interface traders because they are humans and use a graphical user interface. So humans like round numbers, humans trade throughout the day, they think in terms of time. So they often trade in predictable time patterns, round lots, which can be exploited by the HFTs or these algorithms, as we discussed. So what is the impact on financial markets and regulation? Policymakers and regulators are now trying to decide whether they should impose restrictions on the FCTs. Circuit breakers have been put in place to protect against big market crashes, like those stop loss limits that these pack hunters may try to achieve. Halt trading if the market has fallen by a certain percentage. So the problem will still remain that it will still cause a big market crash before the circuit breaker gets activated. So regulators need solutions that will prevent these programs to take over in the first place and not after the damage is done. So Chicago Mercantile Exchange, for example, has a stop logic which will look at the orders in its books and assess the impact if the orders are executed. So the stop logic will stop the trades or stop the market execution before the orders gets executed or before the crash happened. So it is predicted that this logic did stop the bash crash of 2010. It predicted that the market would plunge and stop trading. And in a high-speed world, regulators need to be preemptive and proactive, not reactionary. So restrictions need to be executed in advance. Regulators need more advanced tools to help them predict the problems, and various researchers have developed various theories and ideas to help in this process. So researchers argue that bid-ask spread reflects the risk of trading with someone who knows more than you. It's called an informed trader. So this model is difficult to estimate in a high frequency world where spreads become increasingly low because of the actions of the high frequency traders. So essentially the point that we're trying to highlight is that regulating markets with these algorithms, with these computer based trading is going to become an issue, and researchers are working on this. So another model or another predictive regulatory help is through the VPIN, or the volume synchronized probability of informed trading. So this model will allow researchers and regulators to estimate the toxicity in the market by examining the imbalance between the buy initiated volume and the sell initiated volume. So people with new information cannot profit from it without trading on it. So this research shows that these kind of models can predict the buildup of toxicity or orders by these HFTs or algorithms, and regulators can use these kind of predictive models to help market crashes and regulation and regulate the market. There is a proposal for a high transaction tax that will slow down the speed of trading. So a tax, of course, will make the market less attractive to HFTs, but the problem is that it will make the market less attractive to all traders because it will reduce liquidity. So if for every trade I have to pay a transaction tax, then of course the trades will not be as profitable. So generally it's not considered a very good idea, and United States and England are not going to do this, but Europe definitely has gone this way. And France and Italy imposed this tax, and they saw not just high frequency volume but overall volume in their markets drop by 20%. So of course if you try to regulate in this way, then it can have an impact on overall market liquidity, which at times may not be very good. We need healthy liquid secondary markets. Futures markets generally have fees for excessive order cancellation. So these predatory programs may not be able to work because if they just try to confuse markets by placing orders and then canceling them. But in equity markets, generally there is no cancellation fees as such. So in general, these cancelled orders are not a problem. But when an algorithm puts multiple exchanges or venues that are looking for liquidity, and the algorithm then cancels the orders, so in theory it is all right to put an order and then if you don't find liquidity, cancel the order. But the only problem is that if you're able to manipulate the market or give an impression of enhanced liquidity, then it becomes an issue. So that was one of the risks that also needs to be studied, that these manipulations by these high frequency traders or algorithms shouldn't happen. So to summarize, the risk management tools also need to be a little bit different. Regulators are still trying to figure out what type of constraints need to be in place so that these high frequency traders don't cause any problems for the market. If it's just enhanced liquidity, it's good for everyone. If it's just trading on valid information, it's all right, and even a slight profit will just make the markets more efficient, so that's all right. Only thing is that it shouldn't be predatory and it shouldn't cause big crashes or some unwanted effects, is what regulators are trying to figure out and trying to put regulations in place. So just to highlight the risks in trading, there is generally a trade-off between the liquidity risk versus the timing risk. So the difference between the decision price, that means the price at which the trader decides to buy or sell, and the final execution price, which includes taxes, transaction costs, contains two components, a timing component and a liquidity component. So let's say I decide at $100 that I want to buy stock A, but by the time the order gets executed, the actual executed price of, let's say, 1,000 shares of stock A, the executed price comes out to be, let's say, $103. So there's a $3 loss or a $3 gap between when I decided, or the price at which I decided to buy, and the price at which I actually bought. This can be explained by a timing component and a liquidity component. So when a trader wants to execute immediately, liquidity costs will be high. There are not enough sellers available at 100. But if you want to quickly execute your trade, then you will have to pay a slightly higher price in order to execute or finish your quantities. If the trader can wait, the liquidity costs will be lower, but the timing risk will increase. So the price of the asset can move up. So maybe at $100 when I placed the order, there wasn't enough liquidity, so I waited for liquidity, but by the time the liquidity came, the price had already moved up. So the trader is normally always trying to find the point where liquidity and timing risks are minimized. So for instance, if you assume that the market is overrun with traders wanting to sell, then an investor who wants to buy now faces low liquidity risk and low liquidity costs because there are so many sellers. So if there's a big negative news on that stock, then generally liquidity will be available if you want to buy. However, a trader who wants to sell in the same market, let's say after a very big bad news on a stock, he will face a high liquidity risk and high liquidity costs, because he's trying to sell in a market where everybody wants to sell. So if the trader who wants to sell waits, the liquidity cost will decline, because after a point some buyers will emerge, but the price would have already declined because of the timing risk or because of the timing component. So generally there's a trade-off between the liquidity risk and the timing risk, and that's what every trader tries to balance, that is, get the best execution price, taking both concerns into account. So that was about the first review on current issues in financial markets. We'll study more about high frequency trading in the coming chapters. So see you soon.